Good morning and welcome to the Killik podcast for Friday the 17th of July. A couple of weeks ago we were talking about the very low levels of sentiment in market, and we felt that a Greek resolution and an improvement in the US economy would start to see markets move through that sentiment rise and markets go up. We've seen for the most part a resolution in Greece over the last week, and we're also seeing quite a decent lift off in economic data coming out of the States. As you can see from that economic surprise index, we're almost hitting expectations there. So now we've gone into the second quarter reporting season, and so far it's been good. So early days yet, but 70% of companies that reported have beaten expectations. And we feel that earnings achievability will be good in this quarter of results. So we should see continuing catalysts for markets through the economic numbers. Where we are seeing a little bit of caution is in the early stages of Q2 is the companies that are focused and exposed to Chinese demand. So we've seen that in the luxury goods sector, we've seen that in the auto components sector so far. Here we've got a chart of the S&P index, the MSCI World China Exposure Index. So those are businesses that are more exposed to China, and then the Emerging Market Index. And as you can see, that Chinese exposure is not helping the performance of those businesses, and we've seen it again in this quarter to date. The other thing that happened this week that's probably a little bit of a change in gear is Governor Carney talking about rate rises in the UK. Clearly, we've also had Janet Yellen saying that she would like to increase rates in the US. So we've seen strengthening of sterling, both against dollar in the last few days, following that Carney guidance, and particularly against the euro, which has continued to weaken this week with more ECB liquidity coming into the market following the Greek resolution. So early days yet, but we've had quite a lot of banks report this week. Wells Fargo had good numbers, stronger mortgage numbers. JP Morgan, we saw really good cost control. And then Goldman Sachs yesterday, we saw very high growth levels in their investment banking division, up 13% in the second quarter. So their results were as good as they have been for about 5 years in Q2. So that's very encouraging. And that's all despite quite a tough environment on net interest margins. Here you've got a chart showing US net interest margins. As you can see, they're still extremely low and not really coming off the bottom. Regulatory fines remain very high. We saw that with Goldman's. And we're still seeing sort of relatively low levels of mortgage originations. So lots of room for these factors and drivers to move to the upside. Yet in the banks we're seeing steady low volatility appreciation to the upside in the share prices. So that's really encouraging. Another big feature this week has been Netflix, which had strong US and international subscriber growth numbers and a very big move in the share price. As you can see, that's been one of the best performers the best performer in the NASDAQ this year. For us, this is demonstrating a theme that we're really interested in, which is the internet disrupting original incumbent industries. And within TV, you've got over-the-top distribution in a non-linear fashion of content, which has just changed the picture for people involved in that. So Netflix, very rough sort of illustration of their business model. Revenue per user at the moment is around $100 per year. The cost per user is $40. With these platforms, they have huge addressable markets, and that's one of the things that's driving Netflix's share price, the ability for them to go into new markets, particularly China, at the moment. The very low ticket cost of using Netflix, around £8 a month, and therefore the very significant potential percentage price increases that you can get by moving that £8 to £10 per month, and without a significant decrease in demand. And finally, the very high operating leverage, because it's one platform and you're simply plugging new subscribers onto an existing infrastructure. So other platform stocks that we have an interest in include Amazon, Google, and LinkedIn. Amazon are reporting next week, and the numbers, the share price has been strong into the numbers. And this is on hope that gross profit per customer is going to continue to accelerate. So what we're seeing is that Amazon are selling more products. There's more sort of third-party products just going through their platform. And so they're getting a higher share of the customer wallet. At the same time, fulfillment costs are falling. So there was a lot of investment in 2012 into fulfillment, and that's now reaching higher capacity utilization. So the effectiveness of that is improving. Equally, on the other side of the business, the Amazon Web Service side of the business, they are finding that they are holding the line on pricing, where Google have reduced their prices pretty dramatically. And that is suggesting that it's not all about price in cloud services. And Amazon, which have been, or AWS, which have been very aggressive in innovating in this space, is creating a competitive advantage that's allowing them to charge a premium price. We also have Apple and Visa reporting next week, and we feel they have the similar sort of platform characteristics, although on lower values than in terms of multiples than certainly Netflix. So Apple has the ability to expand their P significantly from where it is at the moment as they move into different products and services. So we've got obviously the Watch, Apple Pay, their movement into streaming music over their platform. Equally, they're moving into different sectors such as healthcare, cars, home, and finally, geographically, they're expanding into emerging markets pretty rapidly and being fantastically successful in moving into China. Equally, Visa is a very interesting network, payments network or platform. And again, there's strong structural growth stories coming through there. So the movement to digital payments, we've talked about a lot. Growing inclusion in terms of people using digital payments with the proliferation of the devices, and again, opening up of new geographies. But these platforms need high-speed broadband, particularly in the case of Netflix and Amazon. So this allows us to follow a sort of linked thematic play, but in a basket of stocks that's very different investment style to the high growth, high multiple stocks that we've just been talking about. So that's the telecom stocks, typically low valuation in terms of enterprise value to profitability, and high payout ratios, so you get high dividends. So they work well together in a portfolio. Next week we've got Verizon reporting. In the US, the telco sector is now consolidated to 4 key players. We're beginning to see better opportunities in Europe, where you've got over 100 listed telecoms providers, which generate around $40 of revenue per capita against the $90 in the US. So big opportunity for an uplift in that metric. And along those lines, BT has very much been in the news this week, as it looks more likely that Ofcom are going to recommend the separation of Openreach, which is the sort of copper network, last mile network that BT owns, which they effectively sell on to other telco operators in the UK, splitting that from their main business. We continue to feel that BT is a very attractive stock. Firstly, the sort of bigger theme, which is value switching from the content aggregators to the people who can actually deliver that content, the connectivity, and therefore wireless to fixed line, because you can get bigger data rates down those lines. But BT has 60% of total operating cash flows in UK telco, so it's very much the established player. Their networks are considered to be better quality in terms of reliability. But at the moment they're expanding their business into TV, where Sky is the incumbent, and also mobile, where Vodafone is the incumbent with the EE acquisition. So this EE deal cements BT's network advantages as you move from a totally convergent world where you have a seamless transition from in your home to outside of the home, which is important. But this process is encouraging consolidation in the mobile space in the UK, and we think that will probably raise the returns, which are currently below the cost of capital in UK mobile, which will be very good for these stocks. Equally, with that acquisition, they now will be owned, part-owned, 15% by Deutsche Telekom, and clearly Deutsche Telekom, if they do a deal with their T-Mobile business, which they're looking to sell in the States, they will be cash rich, and BT will potentially be a bid interest on the back of that. Finally, going back to the Ofcom consideration, if they did split out Openreach from the core business, you'd probably get a separate listing. The value of that, we think, would probably create some value for shareholders. At the moment, their network is valued implicitly in the share price at around 1 times capital employed, against a replacement value of probably twice that, which is around £20 billion. So just looking at the week ahead in detail, Monday we've got more banks, Morgan Stanley, we've got IBM coming in, Halliburton. Tuesday, BHP Billiton will be interesting. We saw Rio's last week, fairly solid production numbers. We've got Verizon, we've got Apple, we've got Microsoft, we've got Harley Davidson on the Killik list. We've also got SAP. On Wednesday, Land Securities, Marston's and Killik. We've got ARM, which will be interesting, read across for Imagination Technologies. We've got Boeing, Whirlpool, EMC, also American Express, Thermo Fisher will be very interesting. Unilever on Thursday, then Amazon, Visa, Union Pacific, all Killik stocks. We've also got Reed, Elsevier, which are now relics in the UK. Other sort of key stocks, Comcast, Celgene's been in the press a lot recently. Then in Europe, Syngenta, and then Friday we've got Baidu, and Reckitt's will be interesting, and equally Philips and Deutsche Börse. So very busy week ahead for next week. That's it from me. Have a good weekend. Thanks very much.